I guess for now, let's look at the market. Everybody's feeling bad, man. We didn't have a really big slump like last time, but on the Twitter sphere and everywhere that I've been reading, people are predicting a bear situation and saying there's going to be a credit crisis and lots of doom and gloom. Everybody's trotting out Peter Schiff to talk because Peter Schiff is finally right after how many years of predicting the end of markets. I don't think it's that bad. Certainly, things are bad in Italy. Um, and in terms of the trade of the week, um, let's just go back and look at it. So we were going long from about 68 and a half. And what's happened is it's sort of gotten up to that level a couple of times and doesn't feel like going past it. In retrospect, I probably should have thought after such a large drop that making a long term weekly trade is maybe not the best way to get started. Not the best way to build trust. But, I just didn't really think I'd have time to do a lot of scalping. I'm not ready to talk about my scalping strategies. But that is usually a better course of action after a big drop. Markets consolidate. They usually operate within a range. You can see clearly that the Aussie yen is staying in a range, and it might stay there for quite a while. So I don't know what I would ordinarily do if I wasn't sharing this trade with everyone. I think I'd probably just leave it, and I think I'm just going to leave it. But my expectations are diminished. I thought we'd see a nice V, and we're not, and I don't think we will. It may sort of limp its way up to the green line and then come down again. Not sure. Um, but definitely losing steam, and I don't think it's going to be able to hang out in this sort of extended pattern for much longer. It's going to probably start dropping again. Short trade might be looking really good. In terms of the overall S&P 500, it's kind of in a wait and see mode still, but sort of, people are gloomy right now, and some of the news reports are like breaking news: S&P 500 is now in bear territory, but I mean it was lower yesterday. So all I see right now is that we're in a range and that the floor is rising a little bit. It might again keep going. This is my panic area here. I'm not going to change any of my long-term investments until we go past that. But I will take things off if it goes past that because you have to control your losses. That's one of the principles of safety. Um, yeah. So not a great day. I have had some fun scalping in my other accounts, but I'm not really ready to talk about that just yet. What am I ready to talk about? Um, Man, you'd think this would get easier and then I'd get more organized. All right, let's talk about education. A little warning. Actually, this is the perfect lesson for a day like today. Absolutely perfect. All right. Sit on your hands. Principle number 3. Trades are easy to get into and hard to get out of, just like relationships. Um, you might like to play the field, you might like to be a bit of a player, but you will get burned one way or another, whether it's from the STD of poor risk management or from a jilted market, if I may take that metaphor absolutely nowhere. Um, you should basically treat trades as a commitment and decide whether you're going to stick with it. The Aussie yen trade that I picked is a good example. I thought it was worth sticking with, and I'm going to stick with it because I think it's sort of a subsidiary market whose fortunes depend roughly on a recovery in the overall equities market and general risk on sentiment coming back. And because of that, but because it's not directly tied to the S&P 500, it should be maybe a little more resilient. That was my hope anyway. I think that's been borne out because it hasn't, sort of suffered at the same rate as the indices have. Um, but even if it doesn't pan out, you know, I was willing to give it some leeway. What a lot of new traders will do is they'll pride themselves on being really tough with risk and having really tight stops. And there are strategies that work well with really tight stops. I don't want to say that you should never have a really tight stop, but a lot of traders die from 1,000 cuts, putting really tight stops and getting stopped out and wondering why trading is so hard. Um, you should give your trades a chance to breathe. But principle number 3 is basically uh, about sitting on your hands. So this comes from, well, you hear it in the in trading circles a lot. Um, and chess instructors tell their students to do this too. Sit on your hands and just think. Once you have a move in mind and you're ready to move that piece, just keep sitting on your hands and think about what the move is that you're going to make. And you should hopefully be able to ask yourself, before you go clicking or moving and taking a risk, ask yourself if you've considered the risk. Beginning traders always ask, how much money can I make? But veteran traders are almost always asking, how much money can I lose? The difference is huge between those two mindsets. And it represents a journey, a very painful journey for most. Um, while you're sitting on your hands, you can ask yourself if you're following your plan or are you giving into an emotion? Is this trade that you're about to enter into strategic? Or is it a whim? So, yeah, think of every trade like beginning a new relationship. And if you're not really ready to commit to it, stay single. All right, the rest of this is basically about making you feel bad. If you didn't listen to my advice in the previous chapter, prepare to abandon all hope. One thing I want to talk about is why are there so many scams in Forex? There must be thousands, if not hundreds of thousands. Why? Let's consider some of the reasons why I started trading. It was partly out of curiosity. I wanted to learn how money really works. And that journey of discovery sort of led me to Forex because the barrier to entry is low. But I also felt like I had no other choice. And it had to do with um, a career change and my wife's career change. And we left the small town that we were living in up north, came back to the big city. And I was just like, money has so much influence on my life. I want to know everything about it. I want to know who has it and why. I want to get a fundamental understanding of economics because that was something I was never interested in before. My background had nothing to do with finance really when I was going to school and in my work. But this is a chance for me to do that now that I have a little downtime, and that period wasn't really a bright period for me because it was kind of like I was floating and sort of trying to find my way again, and not, in the early stages of my life, but in midlife, which is not great if you can avoid it. But again, being able to do something like that, it's important. So yeah, that sort of ties into what are the reasons why people start trading, especially forex trading, which is definitely designed for suckers and to trap suckers. Um, the one of the reasons is that you don't have enough money to trade stocks or to trade in a better regulated market. Trading in futures, for example, there are a lot of barriers to entry, a lot of hoops to jump through. You need to have a minimum amount of capital before even embarking on it, and that's one reason why forex attracts desperate people. Desperate people are perfect suckers. And then another category of perfect sucker is lazy, greedy people. Lazy and greedy folks, I'm sorry to say, almost 95% of humanity can go in either of those categories at any particular time. Not you, of course, good listener or viewer, um, but most people at some time or other, myself included, uh, could be accused of those two traits. Um, I guess, well, I mean, I'll talk about motivations a little bit later in the next video, but most people approach trading for the wrong reasons. The common ones, as I mentioned, greed and fear, which is desperation. They're the main reasons that people do anything, really. If you think about the laissez-faire theory of economics, they're the dominant emotions in the market itself, but not necessarily great reasons for trading. Um, I mentioned a better one uh, earlier in the previous video, which is about wanting to restore some balance. Not only in your life, like wanting to free up time is a good reason. Wanting to be independent, but wanting to become a millionaire is not necessarily a good one. Not realistic. All right. This is Jesse Lauriston Livermore, one of the most famous traders in history, and the subject of a very important book. Um, and I'm just going to bring it up right now. Reminiscences. Boy, reminiscences is a hard word to spell. As soon as you put it in, though, Google knows what you're talking about. Reminiscence of a Stock Operator. It was actually written by Edwin Lefebvre, who must have had a memory like a steel trap, because he was talking, I think, off the record with Jesse Livermore, who didn't necessarily want this book to be published, and so Lefebvre changed the name in the book. Um, but he didn't change it that much. What did he call him? No, it doesn't say here. Anyway, it's a very thinly veiled fictionalization of Livermore's actual approach to trading. Very, very good book. Very good book about the mindset of traders and the mindset of the counterparty in trading, because things have not, believe it or not, changed that much since the 1920s. They still think about um, people the same way, and bucket shops, the notion of a bucket shop hasn't changed that much. Although there is theoretically more regulation in place to protect people, and theoretically people are a little more sophisticated than they would have been back in those days, but not really. Um, yeah, so very interesting story. But the reason I'm mentioning Livermore right now is a cautionary tale because even though he was one of the most successful traders of all time, made millions of dollars in the 1920s, which would have been equivalent to billions now, and uh, he was so successful that people wouldn't accept his money. They wouldn't let him trade because of his reputation. Um, but he died broke and he committed suicide uh, because partly he felt like he was a failure. And I'm sure that he was suffering from depression. And we know now a lot more about depression and how um, it's not always something that is controllable, but it's not always in the control of the person who has it. But he didn't set aside much of his fortune. He was always going all in. He was going, uh, what did they call it in the book? It's like hauling rope or pulling a lot of rope. It's basically making heavy trades, over trading, and putting all of his capital at work in the market, which is never something that you really want to do. So I guess the reason I'm putting it in there is just to remind you that even the most successful person in this game can end up losing it if they're not careful. I love this cartoon. Learning curves of professions. You see that social work. Go away, you. I wish I could make this thing. Uh, no, there's no way to make it go away. Um, Social work, medical, and tech all have sort of gently graduated slopes when you're learning, but trading has, I don't know what you would even call this, parabolic, hyperbolic curve, and then little stick men are dying, falling off the edge and getting their corpses are being piled up by this little bulldozer, which is very funny. But yeah, the learning curve of trading is brutal and it's probably perennial. I don't think you ever know everything. All right, so I have to talk about the disclaimers. If I do this once, I don't know if I have to do it every time I do a video. I've seen people do this before. David Hickson of Ascendant Trader prefaces every one of his videos with a disclaimer. I don't think it's necessary. I can't imagine anyone's going to sue me because they lost money in the markets, but you never know. So I'm not offering investment advice. I am not inducing you to buy anything. Um, Read the disclaimer. You'll never be able to sue me, but since I don't trust you to read this much, I will read it for you. I mean, I don't even know if you can read. I don't even know if you speak English. Not entering into any agreement or legal partnership. This is general educational material, not specific advice. I cannot be held responsible for anything bad that happens to you ever for any reason, especially if you watch this in whole or in part. I'm not your dad. Probably not your dad. Trading in any form is a terrible idea. You should definitely not do it. If you disregard this advice, you should know you'll probably lose all your money, and I will not help you move out. All right. Here is a very detailed disclaimer, which I'm not going to read out loud. Um, but you should read the whole thing. Pause the video and read it. But if you don't, or whether you do, you can try to sue me, and your lawyers will have to go back to you to recover the fees because you're not going to get anything from me. All results are hypothetical, blah, blah, blah. I stole this disclaimer from some other website, I don't remember what one, and simply replaced the company name with EBFX because I didn't hire a lawyer to make this. It goes into the risks associated with the stock market as though the risks associated with different markets are different. Cryptocurrencies on margin carry a high level of risk. That goes without, whoa, that is an understatement. All right. All this to say trading is brutally difficult. Don't do it. The choice to become a trader and especially to trade spot effects is not rational. And for the amount of time and energy that you invest in it, you could easily get a degree or a journeyman certificate and a bunch of high paying jobs. Become a doctor, a dentist, someone who actually produces value for society. That's not to say you couldn't produce value for society as a trader, but I think the majority of people are not in it for philanthropic reasons. And if you love adrenaline, if you love dangerous things, you could learn to free climb. It's climbing without ropes. Those people are nuts. You could swim with sharks if there are any left alive in the ocean. You could paraglide, you could base jump, or get your thrills some other way. Trading for a living is like playing Dark Souls with one hand and a controller where the buttons move around. Hopefully, that metaphor isn't completely lost on people on Twitch. Um, it's like playing that game with a couple of 9-year-old kids poking you in their ribs the entire time. You have to be a little bit crazy or a little bit perverse in the sense that you like to, you're so stubborn that you're willing to do something the hard way. And oh, I have a good video to describe that. Finally, some visuals. Let's see. This is something I found. Is this gonna? Oh, there it is. Here it is. It didn't take too long. Let's just refresh this. So these cats are in a cage. They leap out, but there's one stubborn fool who's less interested in actually achieving the objective than they are in achieving the objective their way. And when I posted this on Forex Factory, the caption was "Spot the trader." The cat amazingly managed to get out through that tiny little hole. To me, that is the mindset that you have to have if you're going to trade. I think, or learn about trading. You have to just be so bound and determined to do things your way that the obvious easy way doesn't matter. All right, that is the end of that. Principle number 3: sit on your hands, and think about whether the risks are worth it.